When people talk about the 2008 financial crisis, it's easy to point fingers at ordinary folks who took out loans. But let's set the record straight. The real chaos started on Wall Street, where some of the world's smartest bankers made a series of disastrous decisions that sent shockwaves across the globe. The effects of those mistakes are still with us today. Families lost their homes, jobs disappeared, and entire communities were shaken. Even now, many people are still picking up the pieces. So how did it all unravel? Let's break it down in simple terms, so anyone can understand what really happened. Picture the global financial system as a giant game of Jenga. Each block represents a part of the economy, and the whole tower stands tall as long as the base is strong. At the very bottom of this tower are home loans, also known as mortgages. These are the foundation, supporting everything above. For years, banks were careful about who they lent money to. But then, something changed. Banks started giving out mortgages to almost anyone who asked, even people who didn't have steady jobs or enough savings to make the payments. Why would they do this? Because everyone believed that house prices would keep going up forever. If someone couldn't pay, the bank could just sell the house for more money. It seemed like a win-win. But here's where things took a risky turn. Banks weren't just lending money, they were gambling with it. Instead of holding on to these risky loans, banks bundled thousands of them together into packages called mortgage-backed securities. They sold these packages to investors all over the world, promising they were safe and would make everyone rich. These bundles were like mysterious gift boxes. On the outside, they looked shiny and secure, but inside, they were filled with loans that might never be paid back. Investors, banks, pension funds, even governments, snapped them up, thinking they'd found a gold mine. They trusted the banks and the rating agencies that said these boxes were safe. But the truth was, these boxes were stuffed with subprime loans, mortgages given to people who were unlikely to pay them back. It was a ticking time bomb. When homeowners started missing payments, the whole system began to shake. Houses were foreclosed, families were forced to leave, and the value of those magic boxes collapsed. Suddenly, the Jenga tower was wobbling dangerously. The foundation was crumbling, and everyone was scrambling to get out before it all came crashing down. Banks realized too late that the assets they thought were safe were actually worthless. Panic spread through the financial world. Trust between banks vanished overnight, and nobody wanted to lend money to anyone else. With banks refusing to lend, the entire financial system froze. Businesses couldn't get loans to pay workers or buy supplies. People lost jobs, and the economy ground to a halt. The crisis spread far beyond Wall Street. Shops closed, factories shut down, and millions of people around the world found themselves out of work. The shockwaves reached every corner of the globe. Governments rushed in with emergency plans trying to stop the bleeding. They bailed out banks, passed new laws, and tried to help families who lost everything. But for many, the damage was already done. The 2008 crisis taught us a hard lesson. When greed and risky bets take over, everyone pays the price. It's a reminder that the financial world isn't just numbers on a screen, it's real people, real homes, and real lives. So if you ever hear about an investment that sounds too good to be true, remember the Jenga tower. If the foundation is weak, the whole thing can collapse, no matter how strong it looks on the outside. And next time someone offers you a financial product, don't just look at the shiny wrapping. Always check what's inside the box, because what you don't see can hurt you, and sometimes it can shake the whole world.